All right, let's go ahead and get started. So in this video, I'm going to introduce you to the concept of technical analysis. So what are we going to cover? Well, I'm going to introduce you to the big differences between fundamental and technical analysis, and then we'll talk about some of the basic technical analysis indicators, some of the indicators that you should certainly know, and then I'll mention briefly, just as a couple of side notes, the historical performance of technical analysis and the ability of technical analysts to be able to predict the market over the long term. All right, now, my first question, how do we pick stocks? Well, there's a couple of different ways. We've talked about the top-down approach briefly in our class, where we start off looking at the various markets that we're interested in analyzing for possible valuable stocks. And then once we identify a market that we like based on macro factors, we drill down to sectors and then eventually industries in those sectors. And then finally, we look at firms in those sectors. Well, there's another approach to valuing companies and picking stocks called the bottom-up approach. And the bottom-up approach is kind of the opposite. What you do with the bottom-up approach is you actually value all of the stocks that you can, and you identify the ones that are most undervalued using whatever analytical tools you have. Usually, I would say fundamental analysis would be the best, but to each their own. And then you select the stocks that are most undervalued and put them in your portfolio, and you can weight them however you want based on your analysis and your expected return and standard deviation. Now, each of these approaches can be attacked using either fundamental analysis or technical analysis. Now, since I mentioned this is a video on technical analysis, I won't spend too much time on fundamental analysis, but fundamental analysis is usually what we focus on in an intro-level class in investments. It's a method of valuing a security using a lot of the indicators that we commonly use, a lot of the ratios that we commonly introduce at the intro level for finance, so ROA, or we'll typically calculate the intrinsic value using discounted cash flows. So essentially, we're calculating EBIT, we're adding in depreciation, et cetera. We're calculating our free cash flows and then discounting those expected free cash flows back to the present. And we're using accounting level data to do that. So that's fundamental analysis, where we take a bunch of real world data, either at the economic, the industry, or the firm level, or usually all three, and we try to value the firm, calculate its intrinsic value, and then determine whether or not we should invest in that stock. Now, technical analysis is a little different. So technical analysis is analysis that bases future changes in security prices on historical patterns. So technical analysis in the short version essentially involves you as an investor believing that the market is not efficient, that past returns and past volume of a given stock or a given set of stocks or an ETF or a mutual fund or the market as a whole predict future returns and future volume activity. Now, there's a couple of main techniques that I'm going to introduce to you in this video. Probably the most common technical and analytical tool is the moving average, where we track the average of a stock's price over the last 20 days or the last 50 days or the last 200 days and look at whether or not that stock is above its moving average over that period. We also have trading indexes, and trading indexes tell us essentially a good indicator of market or investor sentiment, and I'll get into that a little later. Next, we have relative pricing measures, or RPI, and there's a couple of these, but they essentially tell us how the returns of one stock or one indicator or one ETF or one mutual fund have performed relative to another. And then finally, we have the put-call ratio, and that tells us another measure of investor sentiment. Let's start with moving averages. So, like I said, a moving average is the average level of prices over a given interval of time, where the interval is updated as time passes. Now, we typically say that when the market price breaks through a moving average line from below, that's considered a bullish sign, or it's a good signal that the share price is about to increase. And so it's time for us to buy those shares of that stock. A bearish signal would be the exact opposite, when the current market price falls below its moving average, whether that's the 10-day moving average or the 20-day moving average, etc. So when we see that bearish signal, a technical analyst might say that it's time to sell that stock. Now, let's take a look at how this works in a real-world scenario. So I'm going to introduce you to Thinkorswim, the Thinkorswim platform, and I'm going to pull up the moving averages on that platform. All right, so what I'm going to do is go over to the Thinkorswim platform from TD Ameritrade and show you how we actually build out these moving averages, and I'll introduce you to the platform as well. All right, so now I'm over here on the Thinkorswim platform, and I've already pulled up Apple, and what you're seeing here is more or less what the platform is. So right now I'm in simulated trading, meaning this is a fictitious account, so you're not actually seeing my real Thinkorswim account. So I'm gonna look at Tesla. So I'll type in over here in the top left, TSLA, Tesla's ticker symbol. And we have about 2 years worth of pricing data on Tesla. So obviously, Tesla is a fairly volatile company. You see its price ranges from about $240 all the way up to darn near 390-ish, 389 and change. Now, I'm going to look at a very specific point in time. Let's zoom in on a couple-day period. All right, so what you're looking at are candlesticks. So this is a candlestick chart. And I'm sure that some of you have probably not seen the candlesticks, or you probably, if you have seen it, you don't know how to read it. So let's go through this. So you have two different types of candlesticks out there. And these green or empty ones, regardless of whether they're green or they're empty, always indicate that the price of the asset, so this is Tesla stock, but it could be anything else, an ETF, for example. These candlesticks that are green or empty indicate that the price of the asset has increased over whatever interval we're talking about. So since we can see down here that these are days, these are day intervals. So for example, this green candlestick right here, the bottom of the actual candlestick part indicates the opening price. The top of this candlestick right here indicates the closing price. And then the top of this line above the candlestick indicates the high of that period or that day. And the bottom here indicates the low of that day, so the low price during that trading day. Now, these pinkish candlesticks are the exact opposite. They indicate that during this interval, the price declined. So the way we read these is the top part of the fat part of the candlestick is the opening price, the bottom part is the closing price, and then the high is up here and the low is right here. So that's how you read a candlestick chart. And then down here we have the volume for each of these days. Now, what I'm going to do is I'm going to add in a couple of moving averages. And to do that, I'm going to go up to Studies and add a study, go over to All Studies, and we'll go to Moving Averages. Or better yet, I'll go to moving averages and just go down to simple moving average, just to make things simple. All right, so what I've added here is a very simple 9-day moving average. This is the default in Thinkorswim. So what this represents is the average price at close over the last 9 days. And that thing will change every single day based on the days that are being averaged. If we want to adjust this, we certainly can. And I can right-click, edit study, and I'll up this to, let's say, 10 days. And now we have a 10-day moving average. If I want to add additional moving averages, I certainly can do that. And that's exactly what I'm going to do. All right, so I'm going to scale up this other moving average. Oh, that's not it. I selected the wrong one. So I'm going to scale up the second moving average I have here to 20 days. And you can see there's a bit of deviation. I'm going to make this 20-day moving average a different color. All right, so now you can see that our simple moving average over the last 20 days prior to the trading day is orange, and our 10-day moving average is teal. All right, so how do we read this, or how do we interpret moving averages? Well, I'll go back to my slide for a second, and there's a couple of different signals that are created when we see these moving averages, and particularly when we see one moving average cross above or below another moving average. So I've just created the 10-day and the 20-day moving average, and you can see the signals that are being created here. So this is just a graphic that I created a long time ago. We indicate typically a bullish signal when the 10-day moving average crosses above the 20-day moving average. So, for example, let's see if we have that going on right here. So right here, where my cursor is, that would typically be a positive signal for a technical analyst. It indicates that the share price might be about to rise after this cross occurs. At the same time, we indicate a bearish signal, or a 10-day moving average crossing below the 20-day moving average typically indicates a bearish signal. So if I go back over here, right about here would be a very bearish signal. It indicates that our more recent moving average, or our moving average that takes into account less information, has crossed below the longer term moving average, which is, as some technical analysts might say, a negative signal. Now, let's talk about the most important moving average, the death cross, or at least the 50-day moving average crossing below the 20-day moving average, or 200-day moving average. When this happens, we say that the death cross has occurred. And this is one of the strongest technical analytical signals, or the one that you might hear about or talked about the most on CNBC. So let me just go ahead and show you what that looks like. So I'm going to go up here to edit each of my charts. Or at least I only need to update one of these. I'm going to scale this up to the 200-day moving average. Now, typically, if you look at one of these technical analytical signals, you'll see, or say something like this, when the 50-day crosses the 200-day, and actually where we have a case of the death cross. I mean, technical analysts will interpret this one way, but a lot of people, including myself, who are fundamental analysts, or people who focus more on fundamental analysis, might tend to discount this having an actual predictive ability. But we'll take a look at it regardless. I'm going to scale up and look at a larger window here. Go to auto zoom, and we can see the 200-day moving average is now the teal line, and the simple moving average, that's the 20-day, is the orange line. So you can see it cross, the 200-day crosses the 20-day a couple of times. So right here, the 20-day crosses above, or crosses from below to above the 200-day moving average, which for a technical analyst would indicate a very positive signal. And then a couple of times over here, it actually crosses to below the 200-day moving average, which would be a negative signal. And then it kind of flip-flops back and forth. Depending on the technical analyst you ask, you might get a couple of different opinions about when you should buy or sell around the death cross, or which moving averages crossing which would be more beneficial or should be traded upon. To each their own. I tend to slightly discount this signal. All right, now let's talk about another set of technical indicators. We have tick and trin. And these are two indicators that you can pull up in the Thinkorswim platform. They're fairly well known amongst technical analysts and investors as a whole. So tick is an indicator that tells you the relative number of stocks having an uptick in the last minute versus a downtick in the last minute. And so that's going to be over the entire market. And trin is just the relative volume going into declining stocks versus advancing stocks. So let's take a look at these in the Thinkorswim platform. So you noticed a $sign in front of those. That's typically what you enter in when you want to look up a very specific function. Let's say we want to look up tick. So this $tick gives us the tick, or the relative number of stocks that have positive news versus negative news. So I'm going to scroll in here and look at the last couple of days. And so what you can see is that there are a large number of stocks that, as of close in each of these days, had positive information or had an uptick in the last minute or so. So this and trin are sometimes used. I mean, I tend to discount them a little, but again, to each their own. Next, we have something that is also widely used called the Bollinger Bands. And the Bollinger Bands provide us the high, average, and low on a moving average, and they give us essentially a confidence interval of the stock's expected returns, we might say, or price. So what the Bollinger Bands are going to do are that they're going to give us the moving average, and then they're also going to calculate that moving average plus or minus a certain number of degrees of standard deviations away from that particular moving average. So for example, if we have the 20-day moving average, the Bollinger Bands would track on the high and the low side, let's say 2 standard deviations above and 2 standard deviations below the 20-day moving average. Now, the reason the Bollinger Bands are important is because they give us what are called support bounds. So they give us our lower and upper bounds. So if we see that the stock price appreciates above the upper bound, to some technical analysts, this would indicate a very positive signal. To some, it would likely indicate a very negative signal, meaning that the stock is overpriced. All right, so let's take a look at how we add these in Thinkorswim. All right, so I'm going to go back to Tesla, and I will adjust this, and we will get rid of the simple moving averages, and I'll go up to Studies and add some Bollinger Bands. All right, so like I said, we have a couple of things here. So let's say we want to take a look at, or let's say we want to get rid of this 200-day moving average. All right, now what we have are the 20-day moving average Bollinger Band, and we also have the high and the low Bollinger Band. So this one indicates this, I guess this would be pinkish or reddish. This top band right here tells us the simple 20-day moving average plus 2 standard deviations above this moving average based on the historical volatility of this stock. And this one down here tells us the lower bound. Now, if I, let's say, scale out, and auto zoom, what you can see is that occasionally this stock, so Tesla, which it might be hard to see, it moves beyond the upper bound or below the lower bound. So let's say I take a very specific point in time. How about right here? So as you can see right here, Tesla's share price very briefly jumps above the upper Bollinger Band. And right here, it actually dips below the lower Bollinger Band. Now, depending on who you ask, which technical analyst you ask, this would indicate a different thing. So I think that we might say that the popular consensus is that when a stock breaks free of its upper Bollinger Band, a lot of technical analysts would say that it might be overpriced or oversubscribed. And down here, where we see it break below the lower Bollinger Band, a lot of technical analysts would say maybe it's undersubscribed, maybe it's undervalued. And so, I mean, it depends on who you ask. All right, now let's talk about relative strength, or the relative strength index. And relative strength is a measure that looks at the extent to which a security has either outperformed or underperformed some other security or the market as a whole. So our primary measure of relative strength is typically the return of security A divided by the return of security B. And usually when we calculate this, security B is going to be a market index. Usually this is also going to be the S&P 500 index. So let's take a look at this. All right, so I've already pulled it up, but I will show you how to get it again. This. So if I go over to Studies, I'll add a relative strength index. So over here, I just go to relative strength, and here we go. All right, so this red line is kind of our baseline, and as you can see, relative strength parentheses SPX. So for this line, this relative strength line, this is giving us the relative strength of Tesla's stock returns relative to the S&P 500 index. So anything above this red line would indicate that the returns of Tesla stock have been superior to those of the S&P 500, and anything below, vice versa. All right, finally, we have the put-call ratio. And the put-call ratio is a ratio that will give us the ratio of puts over calls in a given period. And the way we typically read this is almost as a measure of investor pessimism. So the higher this number is, the more pessimistic investors are about a particular stock, or in particular, a particular market or market conditions. All right, so there's a couple of different put-call ratios. The first one we're going to look at is $PCAL. L, two L's. And so this is going to be the put-call ratio for all listed stocks. And obviously, there's a lot to it. Let's go ahead and take a look at the put-call ratio over a period of time that's very, very small. So this put-call ratio, anything above 1, indicates some level of investor pessimism. In other words, there's more investors interested in buying puts rather than calls. So there's more calls outstanding than puts, or sorry, there's more puts outstanding than calls in the overall market. If we see something less than 1, that indicates that there's more calls than puts, indicating investors might be more bullish. So I'm going to go ahead and remove these Bollinger Bands just to get rid of some noise. And I'll zoom out to a couple of years. Maybe it's better I do something a little simpler. So as you can see, this fluctuates a lot. And recently there have been more calls outstanding than puts. So that indicates investors are perhaps a bit more bullish than they were during certain periods of time. All right, the next put call ratio that we can talk about, or function that we can talk about, is $PCSP. And that's going to be the put call ratio for all stocks on the S&P 500. So these are all puts and all calls on S&P 500 stocks. And as you can see, we are, again, slightly below 1, indicating that there's more outstanding calls than puts, except for right about here, which was about October 12th-ish. I don't know I don't remember exactly what went on there, but that's usually a bad sign, or a sign of some worried investors. All right, let's take a look at what happened during a different time period here. Say, for example, during the financial crisis. All right, looks like I'm not going to be able to go out any further than this, but you can see here that there are a couple of time periods where the number of puts drastically outnumber the number of calls. Now, the last one I'll show you is the $PCI. And this is going to be the put call ratio for all of the Dow Jones Industrial Average stocks, so the Dow Jones 30 stocks. And I'm going to zoom in here over the last couple of days, and you can see that it's, again, still right around 0.7-ish, indicating that there's more interest in calls rather than puts lately. So that's pretty much it. All right, now I'll leave you with this. So I mentioned that I would talk a little bit about the practicality of technical analysis versus some other tools like fundamental analysis. I will say that in the United States, technical analysis, there's not a whole lot of empirical academic evidence suggesting that technical analysts can beat the market over the long term. However, internationally, there is some evidence, particularly for emerging markets, that indicates that using technical indicators like moving averages or Bollinger Bands or some other indicators like TIN or TRIC can actually produce some alpha, can actually help you outperform the market. Now, again, that I guess I should say that evidence is fairly minimal given the number of technical analysts out there, but that evidence is out there. If you'd like any particular sites on that, I'd be happy to give you some, and I will post one link to one of those articles in the comment section of this video. But I'll leave you with this. Are markets efficient or irrational? Actually, a bit of both. This quote is by Loss Peterson. He's one of the big names in investments research on the academic side of things. And this quote kind of articulates the idea that, yes, markets are relatively efficient, but there are cases where investors might actually be irrational. And I will say that we mostly see that irrationality, or we see it more commonly in markets where those markets are more fragmented, or let's say we have higher trading costs, etc. But there is some evidence that markets are both efficient, meaning that the efficient markets hypothesis does hold to some extent, and there is some evidence that markets can be irrational, meaning that technical analysis might actually pay off for investors. So that's that, and I will wrap up here. Thank you very much.